Let's turn our attention now to the emerging markets. And while the current sell-off looks fairly brutal, is it really that abnormal? Joining us for a deeper dive into the markets is our Bloomberg Emerging Markets editor, Srinivasan. He joins us now from our London studio. Srini, great to see you this morning. Thanks for coming in. Put this current move in context for us. You would say this is on a par, or this is par for the course.
Yes, of course. It looks like it's a tumultuous first half, doesn't it? But if you really put it in context and go long term and really see what emerging market stocks do typically, this is an asset class that's riskier and that's more volatile. And a 15, 16, 17% move is not really unusual. You see, during the euro area debt crisis, during the taper tantrum, during the oil price crash in 2014, we dropped about 15, 16, 17%, but then bounced back very strongly. What it shows is that some reasonable bad news can push emerging market stocks down 17, 18%, but it really takes very bad news to push it beyond 20%. So it could be argued that we are at a stage where we could even rebound if there is no further bad news. You see, this was when the US was downgraded in 2011 by S&P, and this was in 2015 when China the Chinese stock bubble burst. Except for those two occasions in the last 10 years, since the financial crisis, we have always rebounded after 17, 18%. That's the context we have to use to look at this current sell-off. This is par for the course. This is not abnormal at all.
You've had a chance to look at the valuations in quite a bit of detail. How do they hold up longer term then, and when you compare them especially to some of the global peers?
Yes, we went through a $8 trillion rally for 2 years through January 26, 2018. And that probably made some people think that valuations have gone high. But if you really look at long-term PE, which is, we call it the Shiller PE because it was developed by Robert Shiller of Yale University, this looks at price as a multiple of earnings over the past 10 years, adjusted for inflation. If you look at that P and compare it with US markets, we are near the lowest valuation in 15 years. I mean, that's a compelling argument for a value buyer. The rally has not even taken the valuation to our long-term average. We are at a very low level. So that is an argument that value buyers are making to say that this sell-off has actually opened up a buying opportunity.
And that, of course, makes a market, doesn't it? The kind of notes coming from UBS saying there's a big opportunity to buy these markets and valuations in the second half. But let's talk about trade wars and how that might impact. I think you've put together a spectacular combination which shows actually the US relationship with the EM is very different to how we might perceive it. Take it away.
Absolutely. The US depends on emerging markets more than the emerging markets depend on the US as far as trade is concerned. Yes, trade war is a clear and present danger. Nobody can underestimate its potential to destroy value, but it's a short-term risk. Markets will get used to it. Only 17% of exports from emerging markets go to the US. But 46% of US exports go to emerging markets. Who's going to suffer more if it comes to that? So trade war has to be seen in the context of how much emerging markets depend on the US, which is growing less because emerging markets are trading between themselves. China trading with India, India trading with Brazil, and so on. So that's what's acting as a hedge against any uncertainty in these times.